The Aussie dollar is beginning to look a little shaky. After hitting an 11-month high of 70.63 on the 10th of June, the currency has since traded back to below 68 and is currently settling around 68.50. The main development that has knocked the Aussie from its perch is a cooling in the global risk mood. And there's been no shortage of news to dampen the mood after the steep gains in equities from late March to early June either. Sharp rises in coronavirus hospitalisations and case counts in large US states that lifted suppression measures early, such as Texas and Florida, have fed ongoing concern over a second wave. In fact, there's more than 20 US states that are currently experiencing a rising trend of new cases. Against that, those states that saw major outbreaks several months ago, such as New York, continue to see encouraging progress. So overall, the total US national case count is not growing. Instead, new case growth for the US continues to fluctuate at around 18 to 25,000 per day. The hope must be that 4 months down the track, higher testing rates, contact tracing and advances in treatment will mean that we do not see a repeat of the New York wave. Interestingly, mortality rates in those US states where cases have been growing have not increased. But the developments in Texas and Florida are nevertheless troubling markets. A cluster of new cases in Beijing, a clash between China and India on the Himalayan border, and North Korea's provocative actions on the peninsula have all added to the skittishness in markets this week too. But investors have absorbed plenty of bad news over the past 3 months, so what's changed? One key factor is the huge rally in risky assets that has left markets looking very overbought and making them more vulnerable to a pullback. That said, it is not clear that we're on the cusp of a major reversal in markets. The rise in new infections is not yet hampering the global rebound, and the extraordinary scale of global monetary and fiscal support continues to wash over markets. In fact, Fed messaging over the last 2 weeks has underscored a deep commitment to ongoing super accommodative policy, and further stimulus, in fact, is still in the pipeline. For example, the Fed's $600 billion Main Street lending program and their $750 billion credit market support program were only launched this week, and their Treasury and mortgage security purchases continue at a hefty $120 billion per month pace. In fact, in the last 2 weeks, the ECB and the BOJ have also provided yet more accommodation too. The global economy is also continuing to crawl out of the abyss as well. The speed with which the virus hit global activity has rendered many important economic data releases out of date before they are published. High-frequency alternative data sets from online companies that track traffic levels, public transportation use and restaurant bookings provide a timelier window into the global economy, and the message there is that a revival of sorts is underway. In fact, some gauges show activity has returned to pre-virus levels in some key parts of the global economy. Turning to local developments, Australia's May labour force survey was a sour note in what had been a hopeful economic story in recent weeks. Around 835,000 jobs are estimated to have been shed in 2 months, and the unemployment rate jumped to 7.1%, a high since October 01. The JobKeeper package, however, has provided vital support, and it seems that Australia is likely to avoid a 10% unemployment rate. This might not move the needle much for the RBA, but it will be notable to hear from Governor Lowe on whether he still sees the economy tracking on the less gloomy side of projections. Overall, the Aussie dollar's domestic story remains supportive too, with states loosening restrictions despite an uptick of COVID-19 cases in Victoria. Preliminary figures from the ABS show a 16.3% lift in May retail sales too, confirming that a revival is underway. On balance, our read is that the pluses still outweigh the minuses, so the recent skittishness in markets should be viewed as a pause rather than the beginnings of a major reversal. We'll speak again next week.